The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures. They show up in opportunity costs. In other words, we have opportunities. We almost do it. In retrospect, we can tell that we were very much mistaken not to do it. In terms of the shareholders, those are the ones in our history that have really cost the most. And very few managements do much thinking or talking about opportunity costs.
This clip is from the 2001 Berkshire Hathaway annual meeting. Right in the ashes of the dot-com bust, Munger and his partner Warren Buffett were asked about their mistakes. Their answer surprised everyone. They said their biggest blunders weren't the stocks they bought that went down. The biggest mistakes, the ones that cost them billions, were what they call mistakes of omission. As Buffett explained, these are the incredible opportunities they saw, they understood, and then they did nothing. These mistakes don't show up on any spreadsheet, but they are devastatingly real. And they all come from misunderstanding the single most important concept in finance: opportunity cost. Munger put it bluntly: all intelligent people should think primarily in terms of opportunity cost. The idea is incredibly simple, yet profound. The real cost of any decision is the value of the next best thing you give up. It's not about what you did. It's about what you could have been doing. Think of it like this. Let's say you own an investment that you think will return 5% a year. Suddenly, a new opportunity comes along that's just as safe, but you're confident it will return 15% a year. The cost of holding on to your original investment is that 10% difference you're giving up year after year. The price you paid for that first stock is ancient history. Its past performance is irrelevant. All that matters are the future prospects of what you own versus the future prospects of your best alternative. This simple idea completely reframes how you see investing. It turns you from a passive scorekeeper obsessed with the past into a forward-looking CEO of your own money, always hunting for the highest and best use for your capital. This brings us back to that gut-wrenching scenario of holding a stock that's down 30%. The emotional reaction is to feel trapped. The Munger-inspired response is to ask one cold, ruthless question, forgetting what I paid for it. Is this company, right now, the best place for my money? You have to compare it to everything else on the menu. Let's imagine your losing stock is a solid company that you now expect to return 8% annually from its current lower price. Your other options might be a savings account yielding 2% or a bond yielding 4%. In this case, selling your loser to hide in cash or bonds would be a huge mistake. The opportunity cost of holding is actually negative. You gain by staying put. Your stock, even though it's in the red, is still your best idea. This framework frees you from the psychological prison of your entry price. Selling only makes sense if you can put that money to work in something with clearly better prospects. And the reverse is also true. Holding on to a winner that's now overvalued and has mediocre future returns is a terrible mistake. If your favorite tech stock is now priced for perfection and you only expect it to return 3% going forward, while a boring industrial company is set to return 15%, the opportunity cost of holding your winner is a staggering 12% a year. You're paying a huge, invisible tax just to keep your bragging rights. Value investing, Munger style, isn't a buy and hold forever religion. It's a dynamic process of buy and continuously compare. You hold something only as long as it remains the best home for your capital compared to other opportunities out there. To really feel the weight of opportunity cost, we have to look at a mistake Munger himself said cost him a fortune, a story he tells to make the rest of us feel better about our own blunders. In the early 1970s, Munger was offered 300 shares of a little-known company called Belridge Oil for about $115 a share. With his analytical mind, he knew instantly it was a screaming bargain. The company's oil reserves were worth many times the stock price. The market was valuing its oil at 29 cents a barrel when the going rate was closer to $6. As he put it, an idiot could see there was no possibility of losing money. He bought the 300 shares, investing $34,500. A few days later, the broker called back with another 1,500 shares at the same price. This would have cost an additional $172,500. But to make the purchase, Munger would have had to sell something else in his portfolio. He described it as a slight inconvenience. He knew Belridge was a much, much better investment than what he already owned. But because of that tiny bit of friction, he said no. That no was a catastrophic financial error. A few years later, Shell Oil bought Belridge in a massive takeover. The stock price exploded from Munger's purchase price of $115 to $3,665 per share. The 300 shares he bought became a $1 million win. But those 1,500 shares he passed on, they would have been worth over $5.5 million. But that's not even the real cost. The real cost is the compounding that never happened. Munger said if he made that extra $5.5 million, he would have rolled it into his venture with Warren Buffett, Berkshire Hathaway. If you trace the compounding of that missed gain through Berkshire's legendary growth, the cost of that slight inconvenience spirals into the billions. Munger himself once quipped the mistake cost him $200 million and later admitted it was probably far more. This is the brutal math of opportunity cost. The mistake wasn't buying a bad stock. It was one of omission, failing to act decisively on a clearly superior opportunity because of inertia. So, how do we actually use this? It boils down to a simple, repeatable playbook for every investment decision. First, you get in the habit of comparing. Munger said, we always have something we like and can buy more of, so that's what we compare everything to. For you and me, this means always having a benchmark idea. It could be a simple S&P 500 index fund, which historically returns around 10% a year. Any new stock you consider has to promise a return that's significantly better to be worth the extra risk and effort. Second, you quantify it. The formula is simple. Opportunity cost equals return of your best alternative, return of your current choice. When you look at a stock, you have to ask, what do I really expect this to return from here? And how does that stack up against what I already own or could own? This forces you to be an active, critical thinker. Third, you act decisively when the odds are stacked in your favor. Munger's wisdom is clear. The wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds. And the rest of the time, they don't. It's just that simple. Great ideas are rare. When you find one like Belridge Oil, one that is overwhelmingly better than your other options, you have to act, even if it means selling something else and dealing with a little inconvenience. So, that 2001 secret isn't some complex formula. It's a complete shift in mindset. The true cost of your investment isn't a number from the past. It's the future return you give up by not putting your capital in its best possible place. It means forgetting your entry price and focusing only on the road ahead. It means understanding that your most expensive mistakes are often the ones you don't even see, the brilliant opportunities you let slip by. If this opportunity cost framework helped you see investing a bit differently, give the video a like. It really helps the channel. And if you want more Buffett and Munger style thinking applied to real decisions like stocks, property, and asset allocation, hit subscribe. See you in the next one.